Finance has always evolved, but the digital revolution has accelerated change like never before. Online banking, mobile payments, and cryptocurrencies like Bitcoin have disrupted traditional systems and democratized access. Decentralized digital currencies challenge the role of central banks and governments. Despite volatility, cryptocurrencies have expanded the boundaries of digital finance. Now, tokenization is emerging, leveraging blockchain to make assets more accessible, efficient, and transparent. This shift is redefining how we invest, own, and interact with value. Investing is no longer just for the privileged few. Tokenization enables fractional ownership, letting anyone invest in assets like art, real estate, or startups. Blockchain-based platforms reduce barriers, cut costs, and increase transparency. Illiquid markets such as real estate become more accessible and dynamic. Investors can diversify portfolios with assets once out of reach. Tokenization is democratizing and transforming the investment landscape. Fractional ownership is being revolutionized by blockchain. Blockchain's decentralized, immutable ledger ensures secure, transparent records of ownership. Smart contracts automate agreements, reducing the need for intermediaries. Transactions are tamper-proof and auditable, building trust. Rental income or dividends can be distributed automatically to token holders. Blockchain makes managing shared assets efficient and reliable. Tokenization is breaking down barriers in finance. Fractional ownership lets more people invest in high-value assets. Smart contracts automate processes, cutting costs and boosting transparency. Markets become more efficient and accessible for all. The technology is evolving rapidly, with real-world impact already visible. As regulations adapt, tokenization's influence will only grow. A token is a digital certificate of ownership or rights, secured on a blockchain. Tokens can represent anything: real estate, company shares, art, or loyalty points. Fungible tokens like Bitcoin are interchangeable. Non-fungible tokens, NFTs, are unique. NFTs are used for digital art, collectibles, and virtual assets. Blockchain ensures secure, transparent tracking of all tokens. Tokenization unlocks new ways to own and trade value. Blockchain is the backbone of tokenization. It's a decentralized, tamper-proof ledger shared across a network. Each transaction is recorded in a block, creating a transparent, auditable chain. No single entity controls the data, making it resilient and secure. Publicly viewable transactions promote trust and accountability. Blockchain's transparency and security make it ideal for managing digital assets. Tokenization starts by defining the asset and its rights, then issuing tokens on a blockchain. Platforms like Ethereum enable smart contracts for automation and security. Tokens are created, distributed, and secured using cryptography. Public and private keys protect transactions and ownership. Hashing algorithms ensure data integrity. Security and transparency are central to the tokenization process. Smart contracts automate and enforce agreements on the blockchain. They handle tasks like rent distribution or regulatory compliance without intermediaries. Only eligible investors can participate, thanks to built-in KYC/AML checks. Smart contracts reduce costs, increase transparency, and enable complex financial products. They're transforming everything from escrow to supply chain management. As blockchain evolves, smart contracts will unlock even more possibilities. Token standards like ERC-20 and ERC-721 ensure compatibility and security on Ethereum. ERC-20 is for fungible tokens, identical and interchangeable. ERC-721 is for NFTs, unique and individually tracked. Standards simplify development and promote interoperability. They make it easier to build secure, reliable applications. Token standards are the foundation of a robust tokenization ecosystem. Tokenization bridges traditional finance and the digital world. Assets like stocks or real estate are mirrored as digital tokens on blockchain. This enables fractional ownership and lowers barriers to entry. Blockchain's transparency reduces fraud and builds trust. Tokenization empowers broader participation and financial inclusion. The future of finance is more open, efficient, and accessible for all. One of the most significant advantages of tokenization over traditional finance is, honestly, its ability to fractionalize ownership. Traditional assets like real estate or fine art often require substantial capital to invest in, which really limits access to a select few. But tokenization breaks down these barriers by dividing ownership of an asset into smaller, more manageable units that are represented by tokens. Imagine a luxury condominium worth millions of dollars, something typically out of reach for the average investor. Through tokenization, this property can be divided into thousands of tokens, with each one representing a fractional ownership stake. This means investors can purchase just a portion of the property with a significantly lower investment, opening up access to asset classes that were previously unattainable. This fractionalization of ownership has the potential to truly democratize investing, empowering individuals to diversify their portfolios and access opportunities that until now were reserved for institutional investors or high-net-worth individuals. For example, a retail investor could own a fraction of a Picasso painting, a piece of a solar farm, or a stake in a promising tech startup, all made possible through the power of tokenization. Plus, fractionalization can enhance liquidity in markets that have traditionally been pretty illiquid. Real estate, for instance, often involves lengthy and costly transaction processes, making it tough to buy or sell properties quickly. Tokenization can streamline these processes, allowing for the seamless trading of fractional ownership on secondary markets, which increases liquidity and attracts more investors. The traditional financial system often operates as a complex web of intermediaries, paperwork, and, honestly, pretty opaque processes. This lack of transparency can lead to inefficiencies, delays, and a lack of trust among participants. Tokenization, which is built upon the foundation of blockchain technology, offers a refreshing alternative, a system characterized by transparency, efficiency, and automation. Every transaction on a blockchain is recorded immutably and transparently, creating an auditable history that's accessible to all participants. This basically eliminates the need for intermediaries to verify transactions, reducing the potential for errors, fraud, and disputes. Imagine being able to track the provenance of a diamond from the mine all the way to the jewelry store, with each step recorded securely on a blockchain. This level of transparency can really revolutionize supply chains, ensuring authenticity and ethical sourcing. Furthermore, blockchain-based transactions can be executed much faster than traditional methods. Settlement times, which can take days or even weeks in traditional finance, can be reduced to minutes or even seconds with blockchain. This near-instantaneous settlement can significantly enhance liquidity, reduce counterparty risk, and streamline financial processes. Smart contracts, these are self-executing contracts coded on the blockchain, further enhance the efficiency of tokenized transactions. They can automate complex agreements like dividend distributions, escrow services, or royalty payments, eliminating the need for manual intervention and reducing the potential for errors or delays. The traditional financial system, with its reliance on intermediaries, often comes with high costs. Transaction fees, custody charges and administrative expenses can really eat into investment returns, making it expensive for both individuals and businesses to participate in financial markets. Tokenization offers the potential to significantly reduce these costs, making finance more accessible and efficient. By eliminating the need for intermediaries, tokenization can streamline transactions and reduce overhead costs. For example, issuing securities on a blockchain can bypass the need for underwriters, legal teams, and clearinghouses, resulting in significant cost savings for issuers. Similarly, investors can benefit from lower trading fees and custody charges when they trade tokenized assets on decentralized exchanges. Furthermore, the enhanced liquidity of tokenized assets can lead to tighter bid-ask spreads and more efficient price discovery. This can result in fairer pricing for investors and a more vibrant and active market overall. The ability to trade fractional ownership of assets on secondary markets can also unlock liquidity for asset owners, allowing them to access capital more easily. The cost savings and enhanced liquidity offered by tokenization can be particularly impactful for small and medium-sized enterprises, or SMEs, which often struggle to access traditional financing options due to high costs and stringent requirements. Tokenization can provide SMEs with alternative fundraising avenues, allowing them to tap into a global pool of investors and unlock growth opportunities. As tokenization continues to evolve, its transformative potential extends beyond simply replicating traditional financial instruments in a digital format. The programmability and versatility of tokens, combined with the power of blockchain technology, really open up a world of possibilities for innovation and disruption in the financial industry. Imagine a future where real estate transactions are conducted seamlessly on a blockchain, with smart contracts automating title transfers, mortgage payments, and property management tasks. Or just envision a world where supply chains are fully transparent, with each step tracked and verified using tokenized assets, ensuring product authenticity and ethical sourcing. Tokenization can also revolutionize the way we think about identity and access. Digital identities, secured on a blockchain and represented by tokens, could streamline Know Your Customer and anti-money laundering compliance, making it easier and more secure to verify identities and prevent fraud. While the future of tokenization is still being written, its potential to reshape the financial landscape is honestly undeniable. As regulatory frameworks adapt to this emerging technology and investors become more comfortable with its complexities, we can expect to see a surge in innovation and adoption, leading to a more accessible, efficient, and equitable financial system for all. The world of traditional finance can often seem like an exclusive club, with high barriers to entry for both investors and businesses seeking funding. But in the heart of Europe, a company called Bitbond is leveraging the power of tokenization to democratize access to capital markets and unlock new opportunities for investors. Founded in 2013, Bitbond is a Berlin-based fintech company that has emerged as a pioneer in the field of security token offerings. Bitbond's journey began with a simple yet powerful idea to use blockchain technology to create a more efficient and accessible way for businesses to raise capital. Traditional methods of fundraising, such as bank loans or venture capital, can be time-consuming, expensive, and often out of reach for small and medium-sized enterprises. Bitbond saw an opportunity to leverage the power of tokenization to streamline this process and open up access to a wider pool of investors. In 2019, Bitbond made history by launching the first-ever security token offering, approved by a European financial regulator. The company issued security tokens backed by a portfolio of small business loans, offering investors a unique opportunity to gain exposure to this asset class. The security token offering was a resounding success, attracting investors from around the world and demonstrating the viability of tokenization as a fundraising mechanism. Bitbond's success can be attributed to its innovative approach, its commitment to regulatory compliance, and its user-friendly platform. The company has developed a robust infrastructure for issuing, managing, and trading security tokens, making it easy for businesses to launch their own security token offerings and for investors to participate in these offerings. Bitbond's platform is built on the Ethereum blockchain, leveraging the security and transparency of this decentralized network. While Bitbond focuses on democratizing access to capital markets for small and medium-sized enterprises, another European company, Token Solutions, is building the infrastructure to bring tokenization to institutional investors. Based in Luxembourg, a global financial hub, Token Solutions provides a comprehensive suite of services for issuing, managing, and trading tokenized assets. Token Solutions recognizes that institutional investors, such as pension funds, asset managers, and family offices, have unique needs and requirements when it comes to investing. These investors typically manage large sums of capital and are subject to strict regulatory and compliance obligations. Token Solutions platform is designed to meet these needs, providing institutional-grade security, scalability, and compliance. The company's platform is built on a modular architecture, allowing clients to select the services they need and integrate them seamlessly into their existing infrastructure. Token Solutions offers a wide range of services, including token issuance, asset custody, investor onboarding, and secondary market trading. The platform supports a variety of asset classes, including equity, debt, real estate, and alternative investments. Token Solutions is committed to working closely with regulators to ensure that its platform meets the highest standards of compliance. The company is a member of several industry associations and is actively involved in shaping the regulatory landscape for tokenization. This commitment to compliance has been instrumental in building trust with institutional investors who are increasingly recognizing the potential of tokenization. The art market, long considered opaque and exclusive, is undergoing a digital renaissance thanks to the emergence of art tokens. Tokenization is democratizing access to this once rarefied world, allowing a wider range of investors to participate in the ownership and appreciation of fine art. Traditionally, investing in art has been limited to a select few with the financial means to acquire and maintain valuable artworks. Galleries, auction houses, and private collectors have dominated the market, often making it difficult for new entrants to gain a foothold. But now, art tokens are changing this dynamic by fractionalizing ownership and making it possible to invest in blue-chip artworks with just a fraction of the capital previously required. Platforms like Masterworks and Mecenas are leading the charge in art tokenization. These platforms acquire high-value artworks, such as paintings by Picasso or Warhol, and then issue tokens that represent fractional ownership of these assets. Investors can purchase these tokens, gaining exposure to the art market and potentially benefiting from the appreciation of these valuable assets. Art tokens offer several advantages over traditional art investing. First, they provide greater liquidity, as tokens can be traded on secondary markets, making it easier for investors to buy and sell their holdings. Second, they lower the barrier to entry, as investors can purchase tokens for a fraction of the cost of buying an entire artwork. Third, they offer greater transparency, as the provenance and ownership history of tokenized artworks are recorded immutably on a blockchain. Real estate, one of the largest and most illiquid asset classes in the world, is ripe for disruption by tokenization. By representing property ownership digitally on a blockchain, tokenization has the potential to unlock trillions of dollars in liquidity, democratize access to this asset class, and streamline real estate transactions. Imagine owning a fraction of a skyscraper in New York City, a beachfront villa in the Bahamas, or a commercial property in London, all made possible through the power of tokenized real estate. Platforms like Realt and SolidBlock are making this vision a reality, offering investors the opportunity to purchase tokens that represent fractional ownership of high-value properties. Tokenized real estate offers several compelling advantages over traditional real estate investing. First, it lowers the barrier to entry, as investors can purchase tokens for a fraction of the cost of buying an entire property. Second, it increases liquidity, as tokens can be traded on secondary markets, making it easier for investors to cash out their investments. Third, it streamlines transactions, as blockchain-based platforms can automate many of the processes involved in buying, selling, and managing real estate. Moreover, tokenized real estate can open up new opportunities for investors to diversify their portfolios geographically. Investors can gain exposure to real estate markets around the world without the complexities and costs associated with traditional cross-border investments. This can be particularly attractive for investors seeking to hedge against currency fluctuations or diversify their holdings beyond their home markets. The emergence of tokenization has fueled the rise of fractional ownership, a concept that is transforming how we think about and invest in assets. Fractional ownership, as the name suggests, allows multiple individuals to own a portion of an asset, typically through a legally binding agreement. This concept has been around for centuries, but tokenization has breathed new life into it, making it easier and more efficient to manage fractional ownership. Traditionally, fractional ownership has been used for assets like vacation homes, yachts, and private jets, where the high cost of ownership made it impractical for a single individual to bear the burden alone. However, tokenization has expanded the scope of fractional ownership, making it possible to invest in a wider range of assets, including fine art, collectibles, and even intellectual property. Platforms like Otis and Ralliard are at the forefront of this trend, offering investors the opportunity to own a piece of everything from iconic sports memorabilia to rare sneakers to vintage cars. These platforms acquire high-value assets and then issue tokens that represent fractional ownership of those assets. Investors can purchase these tokens, gaining exposure to the potential appreciation of these assets and participating in a community of like-minded enthusiasts. Fractional ownership through tokenization offers several benefits. First, it lowers the barrier to entry, allowing investors to participate in the ownership of assets that were previously out of reach. Second, it provides greater liquidity, as tokens can be traded on secondary markets. Third, it fosters a sense of community, as investors can connect with others who share their passion for a particular asset class. While the potential of tokenization is, truly vast, its widespread adoption really depends on the development of clear and consistent regulatory frameworks. Governments and regulatory bodies around the world are still grappling with how to classify and regulate tokenized assets, which often blur the lines between traditional asset classes and digital securities. In Europe, the Markets in Crypto Assets, or MiCA regulation, expected to come into force in 2024, represents a significant step towards creating a harmonized regulatory framework for crypto assets, including tokenized securities. MiCA aims to provide legal clarity for crypto asset service providers, enhance investor protection, and promote overall financial stability. One of the key aspects of MiCA is its classification of crypto assets into different categories, each with its own set of regulatory requirements. Security tokens, which represent ownership of an underlying asset or security, will be subject to stricter rules than utility tokens, which typically provide access to a specific product or service. MiCA also introduces requirements for crypto asset service providers, such as exchanges, custodians, and wallet providers, to obtain authorization and operate within a regulated framework. This is, intended to enhance investor protection and prevent market abuse. The implementation of MiCA is expected to have a significant impact on the tokenization ecosystem in Europe, providing a more stable and predictable regulatory environment for businesses and investors alike. As other jurisdictions around the world develop their own regulatory frameworks, the future of tokenization will really depend on striking a balance between fostering innovation and ensuring investor protection. To truly grasp the revolutionary potential of tokenization, we must first delve into the technological marvel that underpins its blockchain. Imagine a vast digital ledger distributed across a network of computers, meticulously recording every single transaction with unwavering accuracy and transparency. This, in essence, is the power of blockchain. Unlike traditional databases, which are typically centralized and controlled by a single entity, blockchain operates on a decentralized network. This means that no single entity has absolute control over the data. Instead, the information is replicated and synchronized across countless computers, making it incredibly secure and resistant to tampering or fraud. Picture a chain composed of individual blocks, each containing a batch of verified transactions. Once a block is added to the chain, it becomes a permanent and unalterable part of the ledger. This immutability is crucial, as it ensures the integrity of the data and fosters trust among participants. Furthermore, blockchain transactions are secured using sophisticated cryptographic techniques. Each transaction is encrypted and linked to the previous one, creating a tamper-proof chain of ownership. This cryptographic security, combined with the decentralized nature of blockchain, makes it an incredibly secure platform for managing and transferring tokenized assets. While blockchain provides the secure and transparent foundation for tokenization, smart contracts bring an added layer of automation and efficiency to the equation. Imagine a digital agreement etched into the very fabric of the blockchain, capable of automatically executing its terms when predetermined conditions are met. This, in essence, is the power of smart contracts. Smart contracts are self-executing programs that reside on the blockchain. They can be programmed to perform a wide range of actions, such as transferring tokens, enforcing agreements, and managing escrow services. This automation eliminates the need for intermediaries, reduces the potential for human error, and speeds up transaction times. For example, imagine a real estate transaction facilitated by a smart contract. The contract could be programmed to automatically transfer ownership of the property to the buyer once the payment is received and verified. This eliminates the need for lawyers, escrow agents, and other intermediaries, reducing costs and streamlining the process. Furthermore, smart contracts enhance transparency and accountability. Since they are publicly auditable on the blockchain, anyone can track their execution and verify that the terms of the agreement are being met. This transparency fosters trust among participants and reduces the potential for disputes. Section 3. Wallets, your gateway to the tokenized world. In the world of tokenization, your wallet is your passport, your gateway to accessing, managing, and transacting with your digital assets. But unlike your traditional physical wallet, a digital wallet doesn't actually store your tokens directly. Instead, it holds the cryptographic keys that give you control over your tokens on the blockchain. Think of your digital wallet as a secure vault, safeguarding the keys to your digital assets. These keys, typically consisting of a public key and a private key, are generated using complex mathematical algorithms. Your public key acts as your address on the blockchain, allowing others to send tokens to you. Your private key, on the other hand, is the key that unlocks your wallet and allows you to authorize transactions. Just like you wouldn't share your house key with strangers, it's crucial to keep your private key safe and secure. Losing your private key is akin to losing access to your digital assets, as there's no central authority to recover them. Therefore, choosing a reputable wallet provider and following best security practices is paramount. There are various types of digital wallets available, each with its own set of features and security measures. Software wallets, for instance, are typically free and accessible through your computer or smartphone. Hardware wallets, on the other hand, offer enhanced security by storing your private keys offline on a dedicated device. Section 4. ERC-20 and ERC-721, setting the standards for token interoperability. In the ever-evolving landscape of tokenization, Standards are crucial for ensuring interoperability and streamlining development. Just as we have standardized protocols for the internet, blockchain communities have established token standards to ensure that different tokens can interact seamlessly with each other. Two of the most widely adopted token standards are ERC-20 and ERC-721, both of which reside on the Ethereum blockchain. ERC-20, launched in 2015, has become the de facto standard for creating fungible tokens, tokens that are interchangeable with each other, like units of a currency. ERC-20 defines a set of rules and functions that tokens must adhere to, ensuring that they can be easily integrated into wallets, exchanges, and other blockchain applications. This standardization has been instrumental in the growth of the Ethereum ecosystem, enabling the creation of thousands of different tokens, each representing a unique asset or use case. ERC-721, on the other hand, emerged in response to the growing popularity of non-fungible tokens, or NFTs. Unlike fungible tokens, NFTs are unique and indivisible, representing ownership of one-of-a-kind digital assets like collectibles, virtual real estate, or digital art. ERC-721 provides a framework for creating and managing these unique digital assets, ensuring that their ownership and provenance can be tracked securely and transparently on the blockchain. This standard has paved the way for the explosive growth of the NFT market, enabling artists, creators, and collectors to buy, sell, and trade digital assets with confidence. Section 5. Programmability and automation, benefits and risks of a tokenized future. The true power of tokenization lies not only in its ability to represent assets digitally, but also in its potential to reshape the very fabric of financial systems through programmability and automation. Imagine a world where financial transactions are executed with lightning-fast speed, unparalleled transparency, and minimal human intervention. This is the promise and the potential pitfall of a tokenized future. The programmability of tokens and smart contracts opens up a realm of possibilities for automating complex financial processes. Imagine a world where dividend payments are distributed automatically to shareholders, escrow services are executed seamlessly without intermediaries, and supply chains are tracked with pinpoint accuracy, all powered by the immutable ledger of the blockchain. This automation can lead to increased efficiency, reduced costs, and enhanced security. By eliminating manual processes and intermediaries, tokenization can streamline financial transactions, reduce the potential for human error, and make financial services more accessible to a wider range of people. However, with great power comes great responsibility. The very programmability that makes tokenization so powerful also introduces potential risks. Smart contracts, while powerful tools, are only as good as the code they're built on. A single coding error can have cascading consequences, potentially leading to financial losses or security breaches. Furthermore, the decentralized nature of blockchain, while a strength in many ways, also presents challenges. The lack of a central authority can make it difficult to resolve disputes or address issues that may arise. As tokenization becomes more prevalent, it's crucial to develop robust regulatory frameworks and security measures to mitigate these risks and ensure the stability and integrity of the tokenized economy. The transformative potential of tokenization is undeniable, but its path to widespread adoption is paved with regulatory hurdles. Governments and financial authorities around the world are grappling with how to classify, regulate, and oversee this nascent technology, striving to strike a delicate balance between fostering innovation and protecting investors. In Europe, the markets in crypto assets, or MiCA regulation, poised to take effect in 2024, represents a significant stride toward creating a harmonized regulatory framework for the crypto asset industry, including tokenized securities. MiCA aims to bring much-needed clarity to the legal landscape, enhance investor protection, and safeguard financial stability in the face of this rapidly evolving technology. one of the key pillars of MiCA is its categorization of crypto assets into distinct classes, each subject to specific regulatory requirements tailored to its risk profile. Security tokens, those that represent ownership of an underlying asset or security, will face stricter scrutiny and oversight than their utility token counterparts, which typically grant access to a particular product or service. MiCA also introduces stringent requirements for crypto asset service providers, encompassing exchanges, custodians, and wallet providers. These entities will need to obtain authorization from national competent authorities and operate within a regulated framework, adhering to rules designed to prevent market abuse, money laundering, and other illicit activities. While MiCA represents a significant step forward for Europe, the global regulatory landscape for tokenization remains fragmented. Different jurisdictions are adopting varying approaches, leading to uncertainty and potential roadblocks for cross-border tokenization efforts. Harmonization of regulations across borders will be crucial for unlocking the full potential of this transformative technology on a global scale. The world of tokenization often hinges on a crucial distinction, the difference between security tokens and utility tokens. This classification, though seemingly straightforward, can be a regulatory tightrope walk, as it determines the level of scrutiny, investor protection measures, and compliance requirements that apply. Security tokens, as their name suggests, share characteristics with traditional securities like stocks and bonds. They typically represent ownership rights in an underlying asset, such as a company's shares, real estate, or intellectual property. As such, they often fall under the purview of existing securities laws, requiring issuers to comply with stringent disclosure requirements, investor protection measures, and registration procedures. Utility tokens, on the other hand, are designed to grant access to a specific product, service, or platform. Think of them as digital keys that unlock functionality within a particular ecosystem. Unlike security tokens, utility tokens don't typically represent ownership rights and may not be subject to the same level of regulatory scrutiny as traditional securities. However, the line between these two categories can blur, especially as tokenized offerings become more complex and innovative. Some tokens may exhibit characteristics of both security tokens and utility tokens, creating regulatory uncertainty and potential legal challenges. This grey area highlights the need for clear guidance from regulators and careful consideration from issuers when designing and launching tokenized offerings. Misclassifying a token can have significant consequences. Issuing a security token without complying with applicable securities laws can result in hefty fines, legal action, and reputational damage. Therefore, seeking legal counsel and conducting thorough due diligence is paramount when navigating the complex world of token classification and regulation. As the tokenization ecosystem matures and attracts a wider range of participants, ensuring the integrity and security of the market becomes paramount. This is where Know Your Customer or KYC and anti-money laundering or AML regulations come into play, aiming to prevent illicit activities such as money laundering, terrorist financing, and fraud. KYC regulations require financial institutions, including those operating in the tokenization space, to verify the identity of their customers and assess their risk profiles. This typically involves collecting personal information, verifying documents, and screening customers against sanctions lists and other databases. AML regulations, on the other hand, focus on detecting and preventing money laundering activities. This includes monitoring transactions for suspicious patterns, reporting suspicious activity to authorities, and implementing internal controls to mitigate risks. While KYC and AML regulations are crucial for preventing financial crimes, they can also introduce friction and complexity to the tokenization process. The need to comply with these regulations can slow down onboarding, increase costs for service providers, and potentially deter some users from participating. Striking a balance between innovation and security is crucial. Tokenization platforms are increasingly exploring innovative solutions, such as decentralized identity verification and blockchain-based compliance tools, to streamline KYC and AML processes while maintaining a high level of security. Collaboration between regulators, industry players, and technology providers will be essential for developing effective and efficient KYC and AML solutions that foster innovation while safeguarding the integrity of the tokenized ecosystem. While the promise of tokenization is vast, its journey toward mainstream adoption is not without its technical hurdles and growing pains. As with any emerging technology, challenges and limitations need to be addressed to unlock its full potential and, pave the way for widespread adoption. One of the key technical challenges is scalability. Blockchain networks, which are really the backbone of tokenization, can face limitations in processing a high volume of transactions, especially during periods of peak demand. This can lead to network congestion, slow transaction speeds, and increased costs, which in turn can hinder the user experience and potentially limit the growth of the tokenized ecosystem. Interoperability is another hurdle. With a multitude of blockchain platforms and token standards in existence, ensuring seamless communication and interaction between different systems can be a complex endeavor. This fragmentation can actually hinder the growth of the tokenized ecosystem, limiting liquidity and creating barriers for users who need to interact with multiple platforms. Security remains a paramount concern. While blockchain technology is inherently secure, vulnerabilities can exist in smart contracts, wallets, and other components of the tokenized ecosystem. Exploiting these vulnerabilities can lead to financial losses, data breaches, and reputational damage, eroding trust in the technology. Addressing these technical challenges will require ongoing research and development, collaboration among industry players, and the development of robust standards and best practices. As the technology matures and solutions to these challenges emerge, the path toward widespread tokenization will become smoother and more accessible. While the transformative potential of tokenization is undeniable, it's essential to acknowledge and address the potential risks associated with this emerging technology. Understanding these risks and implementing appropriate mitigation strategies is crucial for fostering a secure, stable, and sustainable tokenized ecosystem. One of the primary risks stems from the complexity of the technology. Smart contracts, the self-executing agreements that govern tokenized transactions, can be complex and honestly pretty difficult to audit. A single coding error or vulnerability can have cascading consequences, potentially leading to financial losses, security breaches, or disputes. Another risk is market volatility. The value of tokenized assets, like their traditional counterparts, can fluctuate significantly based on market sentiment, regulatory changes, or other external factors. This volatility can expose investors to potential losses, especially in the absence of robust risk management strategies and investor education. Regulatory uncertainty poses another challenge. The evolving regulatory landscape for tokenization can create uncertainty for businesses and investors, potentially hindering innovation and adoption. Clear, consistent, and globally harmonized regulations are essential for fostering a stable and predictable environment for tokenization to thrive. Furthermore, the decentralized nature of blockchain, while a strength in many ways, also presents challenges. The lack of a central authority can make it difficult to resolve disputes, address fraudulent activities, or provide recourse for investors who may be victims of scams or market manipulation. Mitigating these risks requires a multifaceted approach. This includes fostering a culture of security awareness, promoting best practices for smart contract development and auditing, implementing robust risk management frameworks, and advocating for clear and effective regulation. By addressing these challenges proactively, the tokenization ecosystem can mature into a secure, transparent, and trustworthy foundation for the future of finance. Imagine a world where the very essence of ownership, from tangible assets like real estate and fine art to intangible creations like intellectual property and digital art, is seamlessly represented and transacted in the digital realm. This is the transformative vision of a tokenized world where the boundaries between the physical and digital dissolve, unlocking unprecedented liquidity, efficiency, and accessibility within financial markets. In this future, the cumbersome processes and opaque intermediaries that have long characterized traditional finance fade into the background. Real estate transactions, once mired in paperwork and fraught with delays, are executed seamlessly on the blockchain, with smart contracts automating title transfers, mortgage payments, and property management tasks. Investors, regardless of their geographical location or net worth, can gain fractional ownership in iconic landmarks, sprawling vineyards, or even renewable energy projects, diversifying their portfolios and participating in a globally interconnected market. The art world, too, undergoes a profound transformation. Masterpieces once confined to the walls of museums or the vaults of private collectors become accessible to a wider audience through fractional ownership, with art tokens representing a stake in these cultural treasures. Aspiring collectors can acquire a piece of a Picasso or a Monet, while artists can leverage tokenization to gain greater control over their creations, receiving royalties every time their artwork changes hands. The tokenization of intellectual property unlocks new avenues for creators and innovators to monetize their work. Musicians can tokenize their music rights, receiving micropayments every time their songs are streamed or used in commercial projects. Inventors can tokenize their patents, licensing their technologies directly to manufacturers or distributors without the need for intermediaries. Section 2. Financial Inclusion and Empowerment, Unlocking Opportunities for the Underserved. At its core, tokenization carries the potential to democratize access to financial services and empower individuals who have long been excluded from traditional financial systems. By lowering barriers to entry, reducing costs, and fostering greater transparency, tokenization can unlock opportunities for the unbanked, the underbanked, and those seeking alternative investment avenues. Just imagine a world where individuals in emerging markets, who often lack access to traditional banking services, can use tokenized microloans to start businesses, invest in their education, or build a more secure financial future. Tokenization can empower these individuals to become active participants in the global economy, bypassing the limitations of traditional financial institutions and accessing capital on their own terms. Furthermore, tokenization can provide a lifeline for small and medium-sized enterprises, the backbone of many economies but often overlooked by traditional lenders. By issuing security tokens, SMEs can tap into a global pool of investors, bypassing the often prohibitive costs and complexities of traditional fundraising methods. Tokenization can also facilitate cross-border payments, making it easier and more affordable for individuals and businesses to send and receive money across borders. This can be particularly impactful for migrant workers who send remittances to their families back home, often facing exorbitant fees and delays through traditional money transfer services. Section 3. The Evolving Nature of Risk, Navigating the Uncharted Waters of Tokenization. As with any transformative technology, the path toward a tokenized future is not without its challenges and risks. The decentralized and rapidly evolving nature of the tokenization landscape presents unique challenges for regulators, businesses, and investors alike, requiring vigilance, adaptability, and a commitment to responsible innovation. One of the primary risks stems from the inherent complexity of the technology. Smart contracts, while powerful tools for automation and transparency, are only as robust as the code they're built on. A single coding error or vulnerability can have cascading consequences, potentially leading to financial losses, security breaches, or disputes. Thorough auditing, rigorous testing, and the development of industry best practices are crucial for mitigating these risks. Market volatility, a hallmark of many emerging asset classes, also poses a challenge for tokenized assets. The value of these assets can fluctuate significantly based on market sentiment, regulatory changes, or even speculation, exposing investors to potential losses. Educating investors about the risks and rewards of tokenization, promoting responsible investment strategies, and developing mechanisms for market stability will be essential for fostering sustainable growth. Regulatory uncertainty remains a significant hurdle. The rapid pace of innovation in the tokenization space often outpaces the development of clear and consistent regulatory frameworks. This lack of clarity can create uncertainty for businesses and investors, potentially hindering innovation and adoption. Collaboration between regulators, industry players, and technology experts is crucial for establishing adaptable and forward-looking regulatory frameworks that foster innovation while protecting investors. Section 4. Tokenization, a catalyst for a more open, efficient, and equitable financial future. Despite the challenges, the potential benefits of tokenization are too significant to ignore. By reimagining the very fabric of ownership and exchange, tokenization has the power to create a more open, efficient, and equitable financial future for all. The increased accessibility and fractional ownership enabled by tokenization can empower a new generation of investors, breaking down the barriers that have long excluded individuals and small businesses from participating in lucrative markets. This democratization of finance can unlock trillions of dollars in currently illiquid assets, fueling economic growth and innovation. The transparency and automation inherent in blockchain-based systems can streamline financial processes, reducing costs, minimizing errors, and fostering greater trust among market participants. This increased efficiency can benefit both businesses and consumers, leading to faster transactions, lower fees, and a more seamless financial experience. Furthermore, tokenization can empower creators and innovators by providing them with new avenues to monetize their work and connect directly with their audiences. This can foster a more vibrant and equitable creative economy, where artists, musicians, writers, and inventors are fairly compensated for their contributions. As we stand on the cusp of this technological revolution, it is our collective responsibility to harness the power of tokenization responsibly, addressing the challenges while embracing the transformative potential it holds. By fostering collaboration, promoting innovation, and prioritizing inclusivity, we can shape a future where the benefits of tokenization are accessible to all, creating a more prosperous and equitable world. So, the world of finance stands at the precipice of a profound transformation, a paradigm shift, really, driven by the convergence of technological innovation and a growing desire for greater accessibility, transparency, and efficiency. Tokenization, which is the representation of assets as digital tokens on a blockchain, is right at the forefront of this revolution, and honestly, it's poised to reshape the very foundations of how we perceive, interact with, and manage value. It's no longer just a futuristic concept confined to the realms of technological discourse. Tokenization is rapidly transitioning into a tangible reality, with real-world applications emerging across a wide range of asset classes, from real estate and fine art to intellectual property and, well, beyond. This transformative technology has the potential to unlock trillions of dollars in currently illiquid assets, democratize access to investment opportunities, and streamline financial processes, ultimately ushering in a new era of financial inclusion and empowerment. As we've explored throughout this journey into the world of tokenization, The implications of this technological leap are far-reaching, extending beyond the traditional confines of Wall Street and impacting individuals, businesses, and governments alike. From fractional ownership of iconic artworks to seamless cross-border payments, tokenization is, without a doubt, poised to reshape not just the financial landscape, but also the very fabric of our globalized economy. At its core, tokenization is about empowerment, empowering individuals with greater control over their assets, empowering businesses with new avenues for growth, and empowering markets with enhanced liquidity, transparency, and efficiency. By breaking down traditional barriers to entry, reducing costs, and fostering greater accessibility, tokenization has the potential to level the playing field and, honestly, create a more inclusive and equitable financial system for all. For individuals, tokenization opens up a world of investment opportunities that were once the exclusive domain of high-net-worth individuals and institutional investors. Imagine owning a fraction of a Picasso, painting a piece of a solar farm, or a stake in a promising tech startup, all made possible through the fractional ownership enabled by tokenization. Businesses, too, stand to benefit significantly from this transformative technology. Small and medium-sized enterprises, often hampered by limited access to traditional financing options, can leverage tokenization to raise capital from a global pool of investors, fueling innovation and driving economic growth. Tokenization can also streamline supply chains, enhance transparency in transactions, and reduce counterparty risk, creating a more efficient and resilient business environment. Moreover, tokenization can foster greater financial inclusion by providing access to financial services for the unbanked and underbanked populations around the world. By leveraging the power of mobile technology and blockchain, tokenized microloans, remittances, and other financial services can be delivered directly to individuals, bypassing the limitations of traditional financial institutions and empowering individuals to take control of their financial well-being. While the transformative potential of tokenization is undeniable, its journey toward widespread adoption is not without its challenges and obstacles. As with any disruptive technology, navigating the evolving regulatory landscape, addressing technical hurdles, and ensuring the security and integrity of the ecosystem are paramount for realizing the full potential of tokenization. Regulatory clarity is essential for fostering innovation and building trust in the tokenized economy. Governments and financial authorities around the world are grappling with how to classify and regulate tokenized assets, striving to strike a delicate balance between fostering innovation and protecting investors. Harmonization of regulations across borders will be crucial for unlocking the cross-border potential of tokenization and creating a level playing field for businesses operating in this space. Technical scalability and interoperability are also critical factors for the success of tokenization. Blockchain networks, the backbone of tokenization, need to be able to handle a high volume of transactions efficiently and securely, especially as adoption grows. Furthermore, ensuring seamless communication and interaction between different blockchain platforms and token standards will be essential for creating a fluid and interconnected tokenized ecosystem. Security remains paramount in the world of tokenization. As with any digital system, the risk of cyber attacks, fraud, and technical vulnerabilities must be addressed proactively. Developing robust security measures, promoting best practices for smart contract development, and fostering a culture of security awareness will be crucial for maintaining trust and integrity in the tokenized economy. As we look toward the horizon of a tokenized future, the potential benefits extend far beyond simply replicating traditional financial instruments in a digital format. Tokenization has the power to fundamentally reshape our relationship with assets, democratize access to financial services, and create a more inclusive and equitable financial system for all. Imagine a world where individuals have greater control over their data and financial identities, where access to capital is no longer determined by geographical location or socio-economic status, and where the benefits of economic growth are more equitably distributed. This is the promise of tokenization, a future where finance is no longer an exclusive club, but a dynamic, open, and accessible ecosystem for all. The journey towards this future will require ongoing collaboration, innovation, and a steadfast commitment to responsible development. By embracing the transformative potential of tokenization while addressing the challenges thoughtfully, we can create a financial system that empowers individuals, fosters innovation, and unlocks opportunities for a more prosperous and equitable world. The future of finance is being written today, and tokenization is poised to play a pivotal role in shaping this transformative narrative. This is not merely a technological evolution, but a societal one, requiring active participation and engagement from all stakeholders: individuals, businesses, policymakers, and technologists alike. The time for passive observation is over. The tokenization revolution is upon us, and it's time to embrace the opportunities and navigate the challenges with foresight, collaboration, and a shared commitment to creating a more equitable and prosperous future for all. Here's a call to action. Educate yourself. Dive deeper into the world of tokenization, explore its potential benefits and risks, and stay informed about the latest developments in this rapidly evolving space. Engage in the conversation, share your insights, ask questions, and contribute to the ongoing dialogue surrounding tokenization and its implications for the future of finance. Explore the possibilities. Consider how tokenization could impact your life, your business, or your community. Explore the emerging opportunities for investment, innovation, and financial inclusion. Advocate for responsible development, support policies and initiatives that promote responsible innovation, investor protection, and the ethical development of tokenization technologies. The future of finance is not predetermined, it's ours to shape. Let's embrace the transformative potential of tokenization and work together to create a more accessible, efficient, and equitable financial system for all.